Hello, today's US Open live session. It is Tuesday, January the 30th. I'm your host, Nikos Zabouras, Senior Financial Editorial Writer at FXCM. It is a very busy week with tech giants, many of them, five of the Magnificent Seven group, reporting tonight and on. And of course, we also have the monetary policy decisions by the US Fed and the Bank of England. So definitely lots of things to expect. And this what we're going to focus on today. And on the earnings front, we'll mostly deal with the one we consider sort of more interesting at this stage. However, before we begin, as always, please read carefully through the risk warning and the disclaimers. Once again, please go over the risk warnings and the disclaimers carefully. I'll give you a few more seconds to do that, and then we will begin. Okay, let's get the ball rolling. We're gonna shake things off a little bit today. We're going to start with the tech earnings Blitz expected this week, starting tonight, and we're gonna focus mostly on Apple. Then we're gonna head and talk about the Fed and the Nasdaq 100, which will be affected by those events. Then we're also going to talk about the Bank of England, which is due on Thursday, and also about the British pound versus the US dollar. So starting with the earnings, five of the Magnificent Seven report this week. Of course, the Magnificent Seven is a group of big tech companies that have largely been responsible for Wall Street's rally last year. And in fact, let's go ahead and look which are those Magnificent Seven and their performance. So that's the Nasdaq 100, which rallied around 50% last year. Then we have Meta Platforms, which was one of the top performers with nearly 200%, which reports this week, and so does Alphabet and Apple, Microsoft, Amazon as well, and of course we had Tesla already reporting earlier this month. And the last of the Magnificent Seven is Nvidia, of course, the main beneficiary and the enabler of the AI revolution. And you can see this the performance of their stocks over the past year. Now, a quick word about most of those, and then we will focus on Apple. So Microsoft and Alphabet are due tonight on Tuesday. Microsoft is the leader of the AI revolution thanks to its investment in OpenAI, and it has already seen an uplift in its cloud revenue as a result of higher AI consumption. Rival Alphabet was caught off guard as this boom kicked off, but has been making progress. Then on Thursday, we have Meta Platforms, the social media giant who has benefited from its cost-cutting efforts, improvement in advertising environment, and of course renewed emphasis on artificial intelligence, and this have helped it to record top and bottom lines in Q3, and of course a rally in stock as we saw just earlier in the previous graph. We also have Amazon, which also comes from impressive quarterly results, Q3 results, and advances on AI again after a slow start. However, we're going to focus today on Apple, which reports on Thursday. And the reason why we're focusing on this one is because it seems to be more interesting. It's a bit of in a bit of a shaky ground compared to its peers. And we saw on the graph earlier that it underperformed them. It had nearly 50% gains last year its stock, but less than the rest of the Magnificent Seven. And Microsoft already challenges its status as the world's most valuable company, as we have seen it closing with valuation a bit higher than those of Apple recently. Now, of course, if there are any opinions that you want to share with us around what we discussed, or if there are any questions, please feel free to type them in the chat box, and we would definitely like to hear your opinion in regards to Apple and the rest of the topics we discuss. So, the bad for Apple. What was bad? Already, the new year has not started with many good news, mostly negative. For one thing, it had to remove the blood oxygen to comply with EU regulation. And rival Samsung launched AI-powered flagship phones at a time when the Cupertino-based firm has not shared any concrete plans to leverage this transformative technology. So it's definitely there's definitely risk of staying behind, and we have seen that anyone who is the first mover definitely has an advantage on this race. Now, its financials have also disappointed. Revenues have not grown on a yearly basis for the last 4 quarters, and let's bring up a graph to actually showcase this fact. So you can see here the quarterly results of based on the quarterly results of Apple, how it hasn't posted growth since Q4 FY 2022. So it was 4 consecutive quarters of negative growth, making it the weakest streak in 22 years and the worst performance of the iPhone era. The company, of course, does not provide official guidance, but its CFO had said that he expects similar sales to a year ago for the reported quarter. So it could still be flat year over year. It could. There is a risk of it not returning to revenue growth in the reported quarter either. Now, the stock, as you can see on the chart, had hit a record highs in December, late December, mid to late December, and trades close those record highs. But given this lack of growth, such high valuation does raise some concerns. Now, on the other hand, we talked about all the negative stuff essentially, but there are also reasons for optimism. Its bottom line had improved substantially in the last quarter, while its moneymaker, the iPhone, registered a 2.5% year-over-year revenue increase, as the smartphone market used to be bottoming. Saturation, inflation, maturity, various reasons why the smartphone market suffered over the past several quarters, but now there are signs that it has bottomed out. And in fact, Apple managed for the first time to conquer the top spot in smartphone sales globally in 2023, according to Canals. Moreover, we said that it has not been able to grow, but it prepares a new product which could perhaps help in that direction. It is, of course, the Vision Pro, the augmented. In terms of technical analysis for the market, we can for the stock, we can see that it trades close to its record highs, which are at around 200 mark, and it can definitely push higher. And of course, any pullback, as we have seen before, is generally seen as a good time to traders seem to like to buy on the dips. We saw in the previous dips at the start of the month how it was able to bounce back. Now there is, however, scope for further for renewed pressure, let's say, and back towards the 200 period EMA, which had supported it in the previous pullbacks as well, at around 180. However, strong catalyst would be needed for sustained weakness below that level, which would endanger any bullish aspirations. In general, as we said, Apple has lagged its major peers in terms of stock performance, and there are reasons for skepticism around the stock, including the high valuation versus the lack of growth of the recent quarters. But there is also reason for optimism, and if it gets a few things right, it could drive further value for the company and its stock. That's pretty much it for Apple. Of course, the results of these companies will determine the trajectory of the Nasdaq 100, since they were the ones that fueled last year's rally, as we said. And so will the outcome of the Fed's meeting on Wednesday. And let's turn to another graph which shows the US headline inflation. We can see that it has been coming down, but the last print last week showed persistence, even though core PCE fell below 3%. In any case, this progress and the massive amount of tightening has led policymakers to point to an end of hikes, and their December projections imply at least 3 cuts this year. However, recently we saw a more reserved stance by some voters who still advocated, though, for lower rates. Disinflation is progressing, but there are signs of stickiness, as we said, and as shown by the last inflation print. The economy is outperforming. Preliminary data showed the Q4 GDP of 3.3%, very strong, and the labor market is coming into better balance, but remains very robust. So these all point to the need potentially for such prolonged restrictive stance. Now, if the Feds adopt a more conservative approach, then equity markets could be pressured. Investors pricing an aggressive 150, 125 basis points of cuts starting as early as March. It's 50-50 roughly between March and May. And of course, they are also convinced of a soft landing. Now, it's crucial here because if the Fed intends to cut in March, which seems a bit stretched, it should lay the groundwork on Wednesday with the policy statement and with Chair Powell's press conference. And now let's see how the Nasdaq is doing. Of course, given this optimism around the Fed pivot, and of course the strong expectations around the tech sector. The tech-heavy index has been doing very well and recently hit new record highs and looks poised to set even higher ones with an eye on the 18K handle. On the other hand, this will be largely determined by the outcome of the events we have described, the Fed and the tech earnings. And a pullback may be required, perhaps back towards the 200 period EMA line that is located at around 16,840. But for daily closes below it that would endanger the bullish momentum, a significant deterioration in sentiment would be required. Now, with that, we're going to change tack and talk a little bit about the Bank of England, which is due on Thursday. And let's bring up the inflation chart from the UK as well here. Now, the Bank of England is due on Thursday, as we said. It has refrained from tightening over the past 3 meetings, as it has made progress on inflation. You can see towards the end of 2022, it set historic highs, multi-decade highs, but then has been very fast recently. But the last print showed an uptick, and in any case, at 4%, CPI inflation is far from the 2% target. So the Bank of England is in a bit of a bind. Given, of course, that there is also a weak economy. It has not ruled out more hikes, and it's too early about cuts. On the other hand, given the weak economy, it needs to consider pausing and, of course, the lagging nature of monetary tightening. And in general, the Bank of England is one of the worst communicators out there, and we have seen this play out multiple times, and of course, it has a non-committal stance. Now, Thursday's decision will be accompanied by updated projectors. Projections will be monitored closely for the inflation forecast and the market implied policy rate, which is always referenced in those. On the previous projections, they were conditioned on market at interest rates at current 5.25%, around current 4.25% until Q3. So there's definitely a long road for the Bank of England. Now, how this translates to GBP USD. The policy differential has helped it rebound after the October low, as market expect a Fed pivot, but the Bank of England is much further on its inflation target and from such a shift. However, this theme may not be able to drive it much higher, as any restrictive stance, even more hikes could derail the already frail economy and sour sentiment. Now, in any case, it tries to hold the 200 period EMA and the 26% Fibonacci of the last leg up. So as long as it can do that, it can extend its gains above 1.2828 high, but it definitely does not inspire confidence for sustained growth, let alone challenge the next major resistance at 1.142. Now, we can see now that it tests this critical region that we just referenced, which is this one here, and that makes it vulnerable to further correction towards the 38.2% level, but more losses would need a strong catalyst. Once again, we have key events coming up for the GBP USD, for the Nasdaq, and this can spark volatility and create two-way movements as well, and big movements.